outlook across asset classes. Before joining Avalon, he was a portfolio manager at Chilton Capital Management, where he launched the ESG equity strategy and long-short technology portfolio. And he started his career as a cross-assets analyst for a small hedge fund. He's got a BA in economics from Georgetown College and a master's in econ from a University of New Hampshire. He's also an author of a book called After Normal, Making Sense of the Global Economy. Over to you, Sam. Just to start off the conversation, how are you really seeing the current uncertainty play out? How long do you think it will last, and what do you think it could imply for policymaking as well as for the markets in general?
Ooh. So overall, I think what you see is the uncertainty, particularly around the Russia-Ukraine situation. We see that dragging out somewhat longer than markets probably do at this point. We are more on the Ukraine-Russia debacle lasting well into the summer months, as long as you continue to see Ukraine, you will continue to see Ukraine at least have resistance as we go through the summer, whether or not there's some sort of peace deal or whatever, that's just likely to happen. The Ukrainians tend to have a long history of resistance whenever they are taken over, whether that's World War I, World War II, the intervening years, etc. They have a pretty fierce independent spirit. So we would expect the conflict itself to go for much longer than normal. However, we don't think that markets have, call it that much patience. Markets will begin to look through this probably as we enter next week and exit next week. There's other things, call it on the risk menu, that markets will begin to focus on. We think two of those are the US Federal Reserve's tightening policies, tightening monetary policy as we go forward, and whether or not China begins to really pick up the pace in terms of its economy. We get some fairly disappointing data out of China today. On the surface it was fine, but when you really got into the numbers, it really didn't speak to significant acceleration whatsoever. So we're beginning to see that chop, I believe. That's the way that we would look at it, the chop between do markets really want to be risk on and continue to move in an upward trajectory into a potentially less bullish China and a much less accommodated Federal Reserve. So we would say, as you begin to have the headlines on Ukraine, as you begin to wane in terms of sanctions in particular, what the market's going to focus on are going to be the two larger economies and which directions they're going in. That would be our mindset as we head into, call it mid to late March and into the second quarter.
It seems that, we are probably going to be, entering again a prolonged cycle of stagflation, something that, the theme which probably was being talked about a lot early part of last calendar year. And apparently, we're seeing a bit of a repeat of the same as we start this current year obviously because of different factors. But do you think that, we are looking at a prolonged stagflation being a big concern then? And do you think that in that case, central bank especially the G4, they run the risk of overshooting in the tightening cycle? If at all you think that they are either ahead of the curve or behind the curve, depending on the starting point that you're looking at?
The answer to that is yes. So I'll start I'll start at the end and kind of work my way backwards there because it's somewhat interesting. On the stagflation front, I was somewhat hopeful as we entered the year and before Ukraine that we were going to have less of a stagflationary risk as we moved into the summer months, as supply chains began to break up a little bit. It looked as though China was beginning to stimulate. That was going to be a positive. China may have come off of its COVID zero by the middle of the summer. Those were going to be significant catalysts for really beginning to get the supply chain somewhat normalized And then you were going to at least see some of the inflation pressures come out of the market. The invasion of Ukraine, or the Ukraine situation, in my mind, changed a lot of those dynamics. And it changed those dynamics in some weird ways. Neon and the major components that are used to make semiconductors, I mean, that's largely supplied by Ukraine. Odessa in particular, I mean, just that one city is something like 62% of the neon market. And that's going to be a significant hit to beginning to call it play some catch up on the semiconductor front. We only have 8 weeks of neon, refined neon, ready to go in this market. That's a stunning thing.
Right.
So if this drags on for a couple of months, then the whole semiconductors are catching up story is dead. And something I really think we need to be paying attention to going into the second half of this year. And that is a stagflationary force, right? Semiconductors aren't everything. I mean, from kids' toys to automobiles, and that is a significant problem on the inflationary front, regardless of what some people kind of mock me on that. That's a huge problem. Food, huge issue. That's not going away anytime soon. China, Russia, and Ukraine are massive wheat producers. Russia and Ukraine export. China doesn't export that much, but they export some. So that's going to be a huge issue as we move into next month, April, May, etc. That's going to continue to be an issue. Fuel, energy, again, issue. So you kind of have, and I kind of joke, if you have semiconductors, gasoline, and groceries all in short supply and all hitting consumers, that's inflationary, period. And consumers tend to pull back when they see those prices move higher. So do we see stagflationary forces emerging? We think they're just largely embedded for 2022. We think 2022, you can pretty much just write off at this point as being a stagflationary environment. Moving to the G4, do we think they move too fast? The ECB, no. We don't think the ECB moves too fast because the ECB, I mean, who knows? By the time they get to their just allowing their balance sheet to taper off a little bit in Q3, who knows what the environment will be by then. That makes the assumption that the Fed hasn't broken something. I think the Federal Reserve has a much higher likelihood of breaking things before Q3 than people really realize. They have moved off the growth mandate. There's this sense that the Fed will save everybody, at least in the US. There's a sense that the Fed will save everybody once risk assets begin to sell off. That's just not the case this time. Powell was pretty clear when he stated, we are willing to sacrifice growth to get inflation under control, which is interesting because in order to get inflation under control with the type of inflation that we're seeing, you basically have to break demand, and breaking demand is breaking things and going too far. So I'm not really sure why Powell wants to be the next Volcker, but at this point, I think the base case has to be that the Fed will go too far and may do it intentionally. And then when it comes to the BOE, if anybody can figure out what that reaction function is, that's a doctoral thesis and probably a Nobel Prize. Just trying to keep up with who's saying what, why, and what. I mean, they were tightening, then they decided not to tighten. I think they're largely, call it, they want to be relevant and they're not.
No, but if you see, Bank of England actually is ahead of everybody else, right? They were the first one to hike in this cycle. And I think in the past also they've been, generally, Europe has been seen relatively more hawkish as a central bank, vis-a-vis the US actually. And, the kind of movement that you've seen in currencies. In fact, when we started the year, I think the consensus was that even the dollar could probably strengthen in the early part of the year, it would probably lose its strength as other G4 catch up, right? Yeah. Of course, the whole dynamics have changed to the worse because now you're talking about global uncertainty, which obviously, plays very differently in asset classes. Where do you think the USD, from here? Because that has implication for emerging markets, especially equities. Yeah.
So I would say we saw, and this was another interesting one, because there was if you look at Twitter, and we call, when you look at FinTwit, you would think that the US dollar was about to die and that nobody would ever use it again. We did see a significant flight to safety into the dollar. I mean, we've seen that. I would say that accelerated a lot of the dynamics that you just laid out. Right? We had this significant. We have this significant and kind of odd. Call it. Oh, is my voice echoing?
Is there an issue with his voice? I can hear him clearly. Somebody texted me saying that his voice is echoing.
Now it's clear. It's clear.
Okay. No, I was just making sure. Okay, perfect. I just wanted to make sure that I wasn't echoing for everyone. Perfect. So let's see, where was I? Dollar. So the dollar, our outlook for the dollar is to be relatively strong versus call it the G7 currencies. So particularly the euro. We would suggest that later this year, as we move through the summer months and we begin to have at least somewhat of a risk-on bid, or a less of a, call it war bond bid, that you would begin to see EM and some of the other currencies Brazil, major commodity producers, the Aussie dollar, New Zealand, et cetera. We would expect them to perform relatively well versus the dollar, is simply because they have the tailwind of the commodity exposure. We would also expect that the renminbi would perform relatively poorly versus the dollar as we head into the summer months in the back half of the year. If you continue to see these types of numbers, particularly the financing numbers that came out of China this morning, if you continue to see those numbers, China's going to have to stomp its foot on the pedal to get to that 5.5% growth target. It's a plenum year. That's, Xi's not going to allow poor growth into that meeting in particular. So I would say you're going to see them really need to put their foot on the pedal to get to those numbers. That doesn't bode well for the renminbi. They're fairly well stocked when it comes to commodities, and as long as they tend to strengthen the currency into to stockpile, and then tend to allow the currency to depreciate once they've stockpiled. So we're pretty sure they've stockpiled everything but food. So I would watch food imports, and then the renminbi should begin to break a little bit lower. So overall, we would say that the dollar is going to be choppy this year, very choppy. The euro, we think the euro goes back towards 115, 120 after the Ukraine situation. I would say there's probably even some more upside in the euro. This would be second half of the year type dynamics, but more upside in the euro, given what we've seen from particularly Germany on the spending front. They are actually going to spend a bunch of money. That's stimulative, and we haven't seen fiscal stimulus in a real way during, outside of COVID. We haven't seen fiscal stimulus in a real way in Europe in a very long time. So there's some room to push growth a little bit there that I think might be surprising. So I think the euro might actually be the upside surprise versus the dollar this year.
No, but this kind of fiscal trust would be a thing, I think, across, developed markets, if at all. There's especially Europe for that matter, because of the fact that it has much tighter integration with with Russia. Coming back to the China issue, so the currency hasn't really depreciated much in the last 2 months. We have seen emerging Asia being a major hit as far as the current uncertainty that we are seeing. So even INR has almost fallen 2.5% in just a matter of 40 days. While if I see CNH, it seems to be quite resilient, partly because of the growth dynamics, given that the policymakers are still pretty much, pushing into leading the growth, around 5 to 6% the coming year. and the monetary policy divergence is also pretty much visible, vis-a-vis the West. How long do you think it can continue? And if you believe that China's story is still is relatively more resilient, then I think EM Asia probably wouldn't be hit as much, even though their energy dependency is very high, because their trade connection with China actually has improved substantially, if I see, versus say 10 years ago. So our diversification has actually been more towards emerging Asia over the last decade or so, against developed markets. So I think to that extent we could be a tad resilient if at all China shows a decent demand growth or a overall better than expected outcome with regard to its growth outlook.
Yeah, so developing Asia, actually, to your point, looks really interesting here. We do think that the renminbi, to a large extent, has been resilient because of the want to accumulate commodities. They do have, Beijing does have the firepower to keep that currency stable for a while, if they really needed it to be. But overall, I would say we've seen it be stable, a little more stable than I would have expected, particularly over the last month or so. I would say that's probably, in a lot of ways, that's probably a positive tailwind later this year for emerging Asia broadly. Simply because you're going to have the depreciation of the renminbi, and you're going to have some relative strength vis-a-vis the renminbi and likely the dollar. I would say that the dollar here is a little too expensive broadly vis-a-vis Asia, in particular India. I would say that the rupee, in my opinion, is one of the more intriguing currencies here for a number of reasons, but not the least the relative growth differentials, as we had particularly into the back half of 2022 and into the beginning of 2023. Then there's the Fed. I would say if you think the Fed is going 6 times this year, the Fed's going to break something by like the 4th or 5th rate hike, which means the Fed's going to have to go in the opposite direction, which should be good for every currency except for the dollar, generally.
And how do you really see, the rotation between growth and, value stocks really playing out? Generally, we've seen historically, if you see the oil shocks in the past, since the 70s, generally we have seen that, in a growth cycle, both, with regard to Fed hike cycle, as well as probably in the oil shock period, generally the rotation has been in favor of value stocks over growth, and not necessarily it has led to a derailment in the equity markets. What is your sense on that, and how do one really play the equity market at this point in time?
Yeah. So this is specific to the my comment, at least, is specific, yes, relative to S&P.
Yes,
and more U.S. dynamics, because I also and then I'll roll it into call it global markets, because I think that's another interesting way to think about it. I don't think this is your typical growth value cycle, period. I think that's the full stop. Just don't think about this as your normal typical cycle. We have 2 things. One, we had COVID, which turned into the largest tailwind ever for the US markets in particular, because the US market was basically built for COVID. I mean, you had Google, Facebook, Amazon, Microsoft were all the largest weights to begin with, and COVID turned into a massive tailwind for adoption on those fronts. So I think that's the first thing to kind of keep in the back of our heads as we move into this. And it's not your typical Fed cycle either, right? So the Fed is hiking into not because growth is out of control, but because inflation pressures are out of control. And those inflation pressures are things that rate hikes, can't necessarily tame, right? You don't print more ships, you don't pump more oil, you don't plant more food, and you don't make more semiconductors by hiking rates. It's just that simple. So they're not hiking into the typical strength that they normally would be, which is when you would have a positive for banks, which is when you would have a positive for energy dynamics and energy consumption. So I would be very, very, very tentative on whether this is the pivot to value that everybody hoped for. Right? Everybody wanted to say that growth was dead. I would say this is a much more tentative situation on both fronts, and I would much rather play, instead of playing growth versus value in the U.S., I would much rather play U.S. versus Europe. Right? I think Europe has a much more interesting dynamic here vis-a-vis the US on two fronts. One, you have a euro sitting at, and I haven't checked this today, so sorry, but like at 109, 110, which is fairly cheap on the euro front. You have a market that is largely manufacturing and really supply chain constrained, and you have a market that is significantly tied to China. Right? So if you have any sort of stomping on the pedal for China, you're going to have a stomping on the pedal back to Europe. You have Europe spending more money, whereas you don't have the same dynamics in the US, right? You have largely the opposite dynamics in the US. So if you, I would say instead of playing the growth versus value game, I would play the US versus Europe game. That would be my mindset on that front.
And how would you be placed cross asset if I would want to play between debt and equity, and within equity and debt markets? How would you really play, at this point in time?
So I would be largely, I'd be on DAX. I think the DAX is the one, call it, interesting way to play that. CAC 40, somewhat interesting, but not as much. You could just do it generally with stocks, stock 600 maybe, but that's kind of boring. On the debt front, I think that there's some interesting things that are beginning to emerge on the credit side, but I think you have to give it a little time, and hopefully something breaks a little bit here, because the spreads are still too tight to really make the debt interesting unless you're willing to take some serious risk in something like BTPs and expect that the ECB is not going to continue to be as hawkish as it has been. I think that could be an interesting play, but I think those generally spreads remain far too tight across credit and across sovereigns, just generally in Europe. So I think it's mostly an equity play on a relative basis. Call it, you could short S&P, long DAX as just a pair trade, which would be a pretty interesting way to exploit some of the growth versus value trends. Ooh, can't hear you.
Yeah, hi. We are taking questions now. Anyone wants to ask a question? So while we queue up, Sam, I can actually, I'm a little, yeah, JB wants to ask a question. JB, please go.
Yeah, thanks for this. See, the way I've been looking at the ECB is that their script seems to be almost exactly 6 months behind the Fed. Fed looked at inflation data, started signaling tightening. Europe inflation picked up with a few months of lag, and ECB has been signaling tightening, and now they've started tapering. And the way I read it, 4Q, you might see a hike. So do you think eventually we'll end up in the same situation where the market will start building in a series of rate hikes with the ECB, or do you think that they'll stop much earlier than where the Fed would?
So I think it's an interesting question, because I think those are codependents in a lot of ways. That we need to have an idea of how quickly the Fed is going, to see how quickly the ECB can and will go. If the Fed does 25 and then 50, there's a decent chance that U.S. growth radically slows, particularly with energy and food costs at the moment, and you begin to have an ECB that doesn't have to be as hawkish because global growth is doing its job for them on the inflation front and the inflation outlook front. Generally, call it Q3 is when they're going to begin ending or wrap up their purchases. that puts them somewhere late this year, early next year as I call it a modally first rate hike. I would say maybe they get one in, but I don't think it's going to be easy for the ECB to get off of zero in this type of environment, particularly with the issues in Ukraine and the issues around energy there. That's going to be a very, very difficult scenario for them. And to a large extent, the energy costs are going to be demand destructive much faster than they will be in the US. The US is not as energy intensive as it had been. Europe needs to heat itself and doesn't have the resources to do it. So that's going to be a significant issue for them. So I would say, I don't think you're going to have a pricing in of rate hikes, a series of rate hikes for the ECB anytime soon, in any substantial way. You might see it come in on an options adjusted basis in some markets, but I think it's going to be very difficult for markets to price that in as before we get some sort of alleviation on the energy front.
Thanks for that.
Azim, can you ask your question, please?
Yeah, thanks, Madhvi. Hi, Samir. My questions is with respect to, if you look at the two stands on US, it's almost at 25 basis point, and we have not even seen one rate hike, and it's already dropped to 25 basis point. So in terms of business cycle, that is a signal that we are again hitting towards late cycle, or probably a time when, usually the hiking cycle, so to say, ends, because that's where it's heading to a negative zone. So what is the implication for a fixed income, portfolio? If you have to make if you really consider this, then how would you position your fixed income, G7 fixed income portfolio? What will be your, positioning like?
Yeah, so that's a great question. This is the difficult part, right? Because you have a US 2-year already sitting at like 1.7, and we haven't had a rate hike yet. To your point, and you're getting, you're sitting at 1.7 there. You're sitting at 2% on the 10-year. I think that's telling you a couple of things. One, it's the 10-year is telling you that the Fed's not going to get that far without breaking something pretty quickly here. I would say the belly in the US looks somewhat interesting, particularly on USTs. Call it the 3 to 7 year type stuff. Looks pretty interesting for the Fed hike cycle. I'd stay away from the 2. Everybody likes to trade the 2 right now, but the 5s and 7s tend to be more interesting, particularly at this stage. Curve inversion gets a lot of press, but I would say that kind of buying the long end of the curve doesn't make as much sense here as buying call it the fat part of the belly, the 5s and 7s. So I'd be positioning there. I honestly trying to play European sovereigns right now, I think is a great way to lose money pretty quickly. I mean, it was like a 17 basis point move in 5 seconds when the ECB made their announcement in German 2 years. I mean, that was absolutely insane. So I think that's a pretty easy way to lose money very, very quickly, unless you have a very long-term type outlook and have the ability to be a pretty strong hand there. So I would say the US is quote unquote late on the cycle. I like the way that you phrase that. It's a late cycle without a move in rates. And the ECB is early cycle without a move and therefore highly volatile. Bank of Japan, I just don't think that's an interesting thing to do, and they're pegged at 0, so it's going to be pretty hard to squeeze any sort of real trade out there. But some of the European corporate debt call it in a month or 2, particularly if we continue to see high food costs, high energy costs, and if you begin to see any sort of spread blow out there, I think that could be a very interesting play. But you haven't seen any sort of interesting move in US corporate debt. Spreads have stayed very tight there. So I don't envy having to pick a position right now in the fixed income market, but I would say the US bellies that is probably the most interesting place.
Azim, that answers your question.
Yes, it does.
Rahul, you're next, please.
Thanks, Madhvi. Hi, Sam. Good morning to you. So my question is more on the FI outflow, which has been happening in India. And what we seem to gather is, some of that is also because of the geopolitical situation. So we kind of have seen almost an outflow of close to $18 billion in the last 5 months. Okay. So my question is, given that if we were to take a more dispassionate view on Ukraine and we were to think that, look here, the headlines will go away and we may probably be, chasing different headlines. So when is it that, the FIs would start looking back at India? Because, and kind of take a more long-term view in that sense, because, FIs outflow tends to be an headline news item, which then reflects on the public markets as well. Your thoughts, please.
Yeah, so I'll answer that from call it a DM allocator's perspective. The way that a lot of DM allocators are going to play EM in general and India in particular is anytime you see rising food costs, rising energy costs, you hit the sell button and ask questions later, right? So I would say two things. One, I do think that Ukraine, those headlines begin to fade as early as next week in terms of markets giving any sort of nod to it, and then begin to move to the Fed and probably some energy stuff and China, right? Those will become the market's fixation at that point. So I would say you're probably Q2 when people begin to rebalance larger portfolios. That's when you'll likely begin to see some flows back into EM and India in particular. From a longer term perspective, there's very few places in the world that have demographics that are actually interesting for allocators, particularly on the equity front. India's if you don't have an allocation to India and you're paying attention to demographics, you're not really paying attention to demographics. And I mean, it's been a pretty interesting story. The consumer in India, to me, is the real story. So I would say, if you begin to see flows hitting the consumer stocks in India, that's a broader indication that you're going to see much wider flows into Indian markets going forward. I haven't seen those, to be honest. I do have friends that run a consumer-focused India fund, okay. And they haven't really been allocating much lately. So I would say that's probably a story for Q2, and then you'll see some acceleration, particularly as China begins to stomp their foot on the pedal. That'll be a risk-on move in EM generally, and then you'll begin to have a much more favorable tone for Indian equities.
So Sam, when you actually speak for Q2, would that be more like a base case? What may be your worst case in that sense?
The worst case in that sense is that you continue to have a slow-moving China, right? If you have a slow-moving China and a China that isn't stimulating, that'll be a hindrance to EM flows broadly, and that'll keep the dollar strong relative to everything else. One of the really the kickers to investing in India is that you can have a pretty significant move in the rupee during a risk-on move, right? So that's the timing issue that you're going to have from DM. So if you don't have that, I would say the flows probably don't come back until Q3 or Q4. By Q3, I mean late Q3, early Q4, when you begin to have some of the larger mutual funds have their year end in tax loss harvesting.
Okay.
And they begin to reallocate. So, but I really do think that this is more of a general 2Q story. I think EM either gets a bid in Q2 or I would be in trouble if they don't.
Okay. Thank you so much for your response.
Anirudh, can you go next, please?
Thank you, Madhvi, and thank you, Team MK, for organizing this call, and thank you, Samuel, for your time, 4:30 a.m. in the morning. Couple of questions from my side. You spoke of the neon shortage crippling the semiconductor supply chain, which was expected to normalize this year. Any thoughts on whether there can be substitutes to replace neon, which will not make the supply chain normalization as crippling as you are estimating?
Yeah. So sorry.
Go ahead, please.
Yeah, so that great question. Interestingly, in 2014, we had the same issue. Sorry, I'm pouring myself some more coffee. In 2014, with the annexation of Crimea, Crimea is right next to Odessa, and Odessa is the major neon hub. You had a shortage of neon and pushed up prices, I think, 2,000%. So huge moves in neon prices there. You actually had major manufacturers begin to come up with solutions for reducing the amount of neon that was needed in these lasers for etching the semiconductors. So that was a positive, right? That was a net positive for right now. The only issue being that there are other noble gases that you can use in etching semiconductors and in the lasers. The problem being that you get them from the same place that you get neon. Generally, you get it from steel in air capture, making steel in the air capture out of those blast furnaces. So I yes and no. The one semi-positive would be if you don't have the destruction of those facilities in Odessa. That would be a big positive. If you do have the destruction of those facilities in Odessa, just wait for it, because Intel, AMD, NVIDIA, those will just gap down in a pretty significant way, because it's going to take a very long time to replace that on the market. We do have some stocks, right? We have about 8 weeks. That is a fairly tentative number, by the way. It's very difficult to actually parse that out. You have about 8 weeks of drawdown. You can probably extend that to about 12 by using less and being a little less and really moving your yields down on the wafer front. But you're probably only talking about 3 months, and then you're going to begin to have a pretty significant shortage, or you're going to have a pretty significant recycling front. So yeah, it's very difficult to see how you would replace neon without replacing a lot of the basic technology there. And it's hard to see how you would get the gases other than neon without actually getting some neon.
That's helpful. Thanks. Second question is, would you have any view on the alternatives to the Russian oil supply making good the deficit over, say, next quarter or two?
Oof.
How likely is that in your view?
How likely is it? It's so if Saudi Arabia, US, and Russia basically pump, call it 14 million barrel equivalents a day each. It's very difficult for me to see. I mean, even if you were to have an Iran deal, return to JCPOA, which our Corbu's base case is that does not happen. Or if you have a relief of sanctions on Venezuela, our view is that does not happen anytime soon. Neither of those two countries can make up for that type of deficit. The US, even if we just started randomly poking holes in West Texas for oil, couldn't make up for it. We do think that you're going to continue, that's a shortage. If you cut off entirely or Russian oil and gas, which we haven't seen yet, we continue to see Russian oil and gas flowing to Western Europe. If we were to see gas and oil turned off from Russia, there would be no replacing it. It's just mathematically, there's not enough spare capacity out there.
Okay, and the last question from my side, given the stagflationary environment which you're expecting, how should duration risk be managed? And on a related question, which sectors within equities would you position yourself, given your expectations?
Yeah, so we like consumer staples. I think the staples sector is a pretty interesting one here. Ones without, not like, call it not Kellogg or General Mills or anything that's related to food. I think foods, that's going to be margin detrimental, and that's not going away anytime soon. But your Procter and Gamble's, your Kimberly Clark's, things like that can push a little bit of price in this type of environment. So we like consumer staples to a degree, and with a few caveats. Would be staying away from consumer discretionary. Generally, we think the consumer is going, if the consumer wants to buy food, it's going to have to take those dollars from somewhere else, and that's going to be discretionary, detrimental. Normally in a rate hiking cycle, you would say banks would be interesting. We don't think banks are interesting at all here. You need a consumer that's actually doing something in order for banks to look good, and that's just not going to be the case in our opinion. Some energy, we do think US natural gas producers are interesting here, not necessarily oil producers, but the gassy guys are pretty interesting as we move into the summer and probably help restock European supplies. Not that the US can actually do that single-handedly, but we do think that the US will help out on that front. So the gas guys in the US could be interesting. On the duration front, I go back to, you probably want to be longer on the, and towards, call it the fat part of the belly, so 7 to 10 if you're managing duration. I'd be quite long on duration here. It's simply because that's going to benefit on a price basis as the Fed goes to break stuff. I don't think the Fed is going to be able to raise rates to 2.5% and then hold it there. I think the Fed's going to raise rates to 2.5% and then have to go the other direction. So I think now it's a story of be very, very careful, but be longer than benchmark on duration as the Fed goes to break things.
All right, that's very helpful. Thank you so very much for your response. Thanks, Madhvi.
Hi, Abhilash, would you go next, please?
Yeah, thanks, Madhvi. Hi, Samuel. Thanks for your insights. My question is basically an extension of a previous question, which was related to flows into India and emerging markets, right? If I just go back to kind of a pre-COVID kind of a time, there was some kind of a truce between US and China. And most of the global speakers were talking about a decade for China. And investors in India were like highly invested into, say, feeder funds into greater China area. But COVID stuck, and obviously there was a China plus one theme where a lot of money came into India, right? But from the last 6 to 8 months, if I'm like kind of hearing a lot of institutions also speaking, the valuations in China are very attractive. Plus they are pushing in liquidity into the market at a time where most of the developed economies are in a tightening phase. So between India and China, how do you see from your vantage point how the investors are sitting out there? If I do like kind of take a view on India and China in terms of flows.
How would I look at that? It's somewhat of a difficult question, mostly because at least from call it a US point of view, China's very, very difficult to touch right now on two fronts. One, you have the real estate sector that's, to say it mildly, landmines. I mean, the place is very, very difficult to invest in. That makes up a fairly significant portion of what the US investors were playing in. And then you have tech. And Chinese tech vis-a-vis the United States has been pretty poor of late. We saw some earnings numbers out yesterday that were pretty disappointing on the growth front for Chinese tech. That that I would say is negative for flows into China, at least from the West. India, call it from a broader perspective, looks a lot better from call it an allocator's perspective, right? So if you're taking a 3 to 10 year view and you want to buy into China or India, you're buying India over China for two reasons. You're buying it for demographics and you're buying it for stability. Right, you don't have the instability, particularly like real estate. I'm talking about, not political. You don't have the instability within the economic structure that you do in China. That's a pretty low hanging fruit. The only thing is that you need to have, or that I think, in order to get those flows back, you have to have a risk-on type tone to markets globally. That's when flows tend to hit DM, and that's when longer term money in particular comes in, and longer term money is the type of money you want on flows. And again, I think the risk on is something that's Q2 or Q3 this year. I don't think risk on is, you know, a story of once you're done with Ukraine headlines, you instantly go to a global risk on. You probably have a knee jerk, but you don't have a global risk on that's sustainable. You have to have a Fed that has already begun to move, and you have to have Ukraine on the headlines, and you have to have China stomping on the pedal. So I think that's, call it late Q2 or late Q3 for dynamics there.
Yeah, thanks, Samuel. That's helpful.
I have one question, Sam, actually. What is the sense on the commodity cycle? So if I understand, you know, the kind of bull run that we saw last year in commodities has obviously now turned into a more entrenched story. In fact, last year itself, there were a lot of debates with regard to whether we are in a commodity super cycle, you know, and not just a bull run, which probably had a more structural reason given the fact that the US and both China are going to be spending a huge amount in infra. And oil, even though it may, you know, end up, it may even be in a sunset phase, it will still probably in the immediate run would have some demand supply mismatch. This is, I'm talking before the current war took place. And even the metal cycle also, given the fact that, you know, we probably the early part of renewables build out would still require metal as a base metal as a critical input. There was no reason to believe that we were in, you know, a commodity, you know, bear cycle. In fact, it was looking to be a more entrenched super cycle, which obviously would have had implications for countries like us, which are heavily dependent on, you know, industrial metals as well. What is your sense on the commodity cycle? And I think also if you could add your sense on gold, because gold has, you know, has shown a lot of interesting trends from being one of the best asset class in 2020 to being, I think, one of the most mediocre ones, even with a very high inflation last year. And now again, looking to be outshining most asset classes. What's your sense on commodity cycle in general, and of course, gold?
Yeah, so, and sorry, the last part was gold, correct?
Yes,
Okay,
about gold,
perfect.
the way it
Yeah.
behaved in 2020, 21, and currently.
Yeah, so on the commodity cycle front, I think we were seeing call it a industrial metals super cycle beginning in 2020, 2021. You know, and it was a global build out of the electrification or re-electrification that requires a lot of copper, that requires a lot of nickel, that requires a lot of lithium. That was a super cycle that was just beginning. I think is, call it just, you can stamp it. That was really good for New Zealand. That was really good for Aussie dollars. It was pretty interesting run there. It should have been good for Africa, but I've never found a good way to play that on the investment front. So if you find one, please email me. So it should have been good across the board there. It's also a large risk on driver for, and this is the weird part, for EM generally, because Brazil, some of the larger allocations within those EM funds tend to benefit quite heavily from commodity super cycles. So you get the passive flows there. So yeah, I think we were in a super cycle for metals at that point. I think we were everybody kind of wrote off oil and gas pretty quickly there. There was no investment on that front. You did not see new wells in any significant way, and oil went to -30, and everybody was like, look, oil's dead. The lack of investment on the fossil fuel front is going to continue to bite for some time. I don't think we're in an oil and gas super cycle by any stretch. I think there's, once the Ukraine issue is dealt with, at least on the investor front, you're going to see that begin to wane quite heavily and quite quickly. Simply, the US is pretty close to energy independent and can do a little bit more pumping. I think that story is largely going to unwind. Gold is an interesting one on a number of fronts. If and this is from again US pricing, if you get war and 7% inflation and all you get is $2,000 on gold, I think that's telling us something. And I think it's telling us something on two fronts. One, going into the Ukraine conflict, one of the pieces I sent out to clients said, this is not a scenario where you buy gold into a war, because Russia's only asset in the war is gold, right? So you have a significant overhang on the gold front because of the sanctions, right? Sanctions basically made it that if you want to have any foreign reserves, you have to sell your gold. That's what the West did to Russia. That's going to be I would say, a semi-permanent overhang. This is not a short-term thing. This is a pretty big deal when it comes to the gold market. And I think it's going to continue to be that overhang. I would note that crypto did not perform well either. And whenever somebody keeps saying that that's the new gold, it's worth keeping in mind where the hash rates are with crypto. This is a side note, but also important, that when 20% of the global hash rate is in Russia and they threaten to shut off their internet from the rest of the world, that is a huge problem for crypto. So you didn't have, call it digital gold or physical gold, do well in the one scenario where it was supposed to do very well. And on the physical side, it's worth remembering that Russia is a significant producer of gold.
Gold, yeah.
But we don't think that's going to have a material effect on the market whatsoever. Gold does have a fairly liquid physical market globally. So we don't think there's going to be a shortage or anything like that to push up prices in a meaningful way.
Also, where do you really stand on the argument of Bitcoin and crypto assets in general, and of course ESG as well? And do you think carbon emission can actually break its progress?
Where do I stand on crypto? I think crypto is a solution looking for a problem. I don't, it's not something that's extremely intriguing in its current phase, in my mind. It is far too energy intensive. I mean, it's, when we get into an energy crunch, I'm very surprised that that countries aren't shutting off crypto mining in general. So I struggle to see how, without a more energy efficient model, that's going to be useful going forward. It's also kind of interesting. It gets far more expensive to mine as energy prices go higher, and so you shut off mining. It is a convoluted, weird system. NFTs and other DAOs and things of that nature are interesting. There are solutions. I just don't know what the problem is that they're solving. Right? We have, they're like, well, look, we can all go in and buy it. And I'm like, yeah, it's called equities. Look, we have ownership equities. So I'm just not sure what problem they're solving at this point. At some point, I think they'll solve an interesting problem, and we'll be like, oh yeah, that's what crypto's for. But at this point, I don't really see it. The other issue that I would say is, particularly on the ESG front, it's the least ESG thing out there. I mean, it's It is massively energy intensive. I mean, it makes banks look so good on the ESG front. So I'm not a huge fan.
I think India also has taken a very strong stand on cryptos rather. In fact, the Reserve Bank has actually called it a Ponzi scheme.
That's not entirely
the official
untrue.
statements, it has no underlying, and it's not something that the central bank would really really recommend, and we've been very, very staunch in this, the crypto evolution in India. And I think India would be one of the first developing countries to be really pushing hard on the CBDC front. I think this year is going to be they're progressing very, very, very swiftly on that front. So we'll see how things.
So and to that point, and this is, I think, critical, CBDCs are incredibly interesting, particularly for efficient banking. When you get into the mechanics of how that works, those are incredibly intriguing. That would be a significant catalyst. I will say this, yes. That would be a significant catalyst for India and investment, period. That it makes it incredibly efficient. It makes it very, very simple for international investors to get access to rupee. So that would be a big catalyst. CBDCs are very intriguing. I don't think the US is going to do one anytime soon. It would complicate our banking structure quite a bit.
But that is going to be the case with India as well. I think US is still relatively more, integrated with regard to the banking sector. India, banking is like the backbone of us, vis-a-vis the Western countries where you also have, other parallel ways and means to raise credit. I think in India, the credit market is very, very, shallow. It is not very developed. So banking plays a very important role. And I think CBDC coming into picture would be little convoluted. I think it will be more convoluted for us than for the West. And I'm surprised that, US and China, US and Europe for that matter, have been actually laggards in this digital currency front. I'm actually very surprised in their behind the curve status, if I would want to call that. Mr. Tyagarajan, do you have a question? You had texted me if you are there on the call. So he'd asked me a question wherein he's asking how are you really looking at the global liquidity panning out within the G4 space, and how do you think it could actually have implication for asset classes?
On the liquidity front, that's an intriguing one, because you have seen liquidity diminish radically in markets. I think a lot of that has to do with the headline risk at the moment and the moves you're seeing in markets. A lot of people are simply taking risk off the table, and you're just you're not going to see that until see liquidity come back, until the headlines begin to be about something else. You can't have 14 and 15% moves in crude oil and gold trading like a meme stock up and down. That creates a tap on the shoulder, take risk off type environment. A number of the traders that I've spoken with at some of the larger hedge funds in the US have radically reduced the amount of leverage in their books. You have to have the headlines begin to diminish. You have to have moves in markets go back to something that isn't the equivalent of 120 vol. I mean, if you look at realized volatility in oil, it has been massive, and that is a huge problem. Just generally for risk assets. So I would say G4 liquidity is vol related. Once you begin to see vol normalize, then you'll begin to see some of the liquidity normalize, and that'll be better for markets. Until then, I would say it's a risk-off mentality.
Anuja, you're next. Can you ask your question, please?
Hi, Samuel. Thank you for your views. I have two questions. One is, overall, worldwide, do you see defense spends rise? And per se, ESG investors have been reluctant to invest there. How does it kind of change the investment world? And another related question is, now everybody is really talking of, increased focus on renewables. and additional sources of energy, who really has the money to fund those kind of ambitious plans? And thirdly, do you see a possibility of a truce between Russia and Ukraine, and how and when does that shape up, and then would the sanctions go away?
Okay, so I'll take the last one first and kind of work backwards. Let's on the truce with Ukraine. I would say there's likely to be a deal at some point in coming weeks between Ukraine and Russia. I don't know that it might be a truce, it might be a treaty, it might be something completely different. I would say that you're going to continue to see headlines out of Ukraine for years to come. That's not going to be a risk that completely goes away, but it's going to be something that the market largely ignores as we move at least into the summer. Markets tend to refocus themselves rather quickly and have a very short attention span. On the sanctions front, those sanctions are not going anywhere anytime quickly. Those are meant to punish, and those are meant to be painful to Russia. So I would say think of the sanctions as somewhat similar to Venezuela or Iran in terms of duration and intention. They are meant by the US and Europe to be painful and to be excruciating to Russia. That is something that the US and Europe has stated. And you tend to have sanctions go on incrementally and come off incrementally. This time around, you had sanctions go on instantly, but you'll still have sanctions most likely coming off incrementally when they do. But I would say, don't expect that to be a 2 or 3 months away. Expect that to be 2 to 3 year type story in terms of those the majority of those sanctions staying on. On the ESG front, who has the money? Nobody. Nobody has the money to do that. It's just a fact. There's not enough money out there to do it, and quite frankly, I don't know if there's enough copper to do it. Or enough lithium. I mean, if we want to really dig into it, that's going to require like 3 global lithium supplies to do it. So we'll have to, hopefully we'll find some better technology as we move through this. What was the first question?
Anuja, you there? Can you state your first question?
It was on defense, yeah.
Oh yeah,
I
defense.
would say
Yes, global defense spending is going up, and it will continue to move higher. When you have Germany of all places spending an extra 100 billion euros, and then basically perpetually moving up their defense spending, that's a signal. You have Poland increasing. You're likely to have France, UK, Spain all begin to increase their defense spending as well. The US is I would say, I don't think we're going to significantly raise our defense spending because it's already almost $1 trillion a year on defense. But I think you're going to see, call it a global arms race, not in terms of developing, the next nuclear bomb, but in terms of rearmament, given what's going on this year. So I don't think that's a short-term story. I don't think you'll see ESG fully embrace bonds as part of their investment thesis, but I don't think you'll see. I don't think you will see ESG funds being as strict about it either, right? ESG is self-defined in many ways, so you'll see some ESG providers allow for it, and you'll see some not. I would say it would be a mixed bag.
Thank you.
Sanjay, you there? Can you ask your next question, please?
Yeah, thank you for the opportunity. Thank you, Samuel. My question is, can you share your broad thoughts, over the medium to long term with regard to, whether deglobalization and de-dollarization specifically would accelerate from here onwards?
Sure. So we call it re-regionalization. That's call it the Corbu theme. We don't think you get de-dollarization in any meaningful way, and that's called for two reasons. One, what we've seen with Russia in particular was that they had already de-dollarized, right? They had been trying to decouple from the West for a very long time, and they bought euros. And what happened to their euros? Their euros got seized too. So the lesson from Russia is if you want to have your money under sanctions, you have to either hold it in renminbi and hope for the best, or you have to hold it at the IMF. And even the IMF froze the assets. So I think the lesson was, call it a difficult one, but it wasn't one that's going to significantly push for the de-dollarization of the global economy. It'll also be very hard to do so, given the U.S. position on energy and food. But that's a long story. So I don't think you're having a de-dollarization. I do think you're having call it a reshoring globally, right? People want their supply chains closer to them, whether that's manufacturing semiconductors, whether it's manufacturing couches, whether it's manufacturing shirts and ties. They want it closer, and they want those supplies guaranteed across the board. That I don't think that is something that's going anywhere anytime soon. And it's a catalyst for significant domestic spending across the globe. I think you're going to continue to see that. I think you're going to continue to see particularly high-tech and somewhat sensitive industries be required to be at home by major powers.
You mentioned regionalization, right? So, does it, and also that's part of deglobalization in a way. So does it mean that we'll have more inefficient manufacturing, less trading, and therefore, slightly higher inflation over the longer term?
So that's so maybe that's a difficult one to answer on a number of levels. One, you have to make an assumption about the technology and the efficiency with which you're making things, right? So productivity is an important part there. So if you have extremely productive industries and extremely productive procedures on the manufacturing front, you can reshore a lot without employing many people, right? It tends to be that labor costs are where your inflationary inputs are, right? Because you're using the same stuff to make it. It's just the labor that needs to be used. So I would say a lot of developed countries have manufacturing that is very, very productive, incredibly productive, pretty close to on par with some of the areas that they've outsourced if you do it on a labor adjusted basis. So it's not entirely clear whether or not that'll be inflationary, and you get to cut out the shipping costs. And right now, shipping costs are not by far, but are one of the significant structural changes that we've seen since COVID. Is that's one of the expenses that nobody saw coming. So overall, right now, if you were to have reshored everything 2 years ago, inflation pressures would be almost non-existent. So it's tough. It's tough to answer that question on a go-forward basis, but I would say that if central banks are targeting 2% reshoring, whether it's China reshoring its own supply chain or Japan, US, Europe, I would say it's not going to have a significant inflationary effect given the inflation we've already seen. If anything, the inflation that we're currently seeing is incentivizing it rather heavily.
Got it. Thank you for your answer, Samuel. Thank you.
Sam, one last question before we wind up the session. in the current, current scenario, what do you recommend to an asset allocator with a medium risk appetite to really play the market at this point?
Ooh, to really play the market, long only allocator. It's long only. Long only allocator. I would say if you want to play the market, the best place globally for me right now is buying German stocks. Just buy the DAX and call it a day. If you really want to play the market and you have a medium risk appetite, buy Germany. It's that you get two tailwinds. You get a euro that is incredibly beaten up, and you get a fairly cyclical market that can't have any more bad news on its doorstep. So I would say it's not a generational buying opportunity in Europe, but it is a very interesting time to be allocating incrementally there. And if you don't like Germany, you can just do France.
But remain in Europe.
Yes.
I think, with this, we've come to the end of the session. I am sure that the session has added a lot of gravity in our understanding of the complex world of asset class investing and the global economy as well. Indeed, we are in a very fluid world, and I think things can unwind pretty quickly, but only to let new uncertainties probably take center stage. Let's see how things pan out. Sam, any last words, and then everybody can log off.
Thank you very much. I would say I think it's going to be rolling risks, and then once we get through the Fed meeting, pay attention to China. That'll be the risk on. That'll be the risk on pedal. So don't get too excited until after the Fed and before China.
Great. Thank you very much for your time here. Guys, you can log off now. Thank you so much. Have a good evening. Bye.
Thank you.
Bye.
Thank
Bye,
you.
Sam.